There's been some disturbing headlines in the financial press recently, actually all coming out this week and again today. What do you do with it? How do you make sense of it? Well, we'll talk through it here in just a second. Welcome to today's video. This is your next wise step for today, Thursday. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. If you're new to this channel, hit that subscribe button, turn on notifications, smash that like button, and share this content because we're getting hit with a lot of financial data and economic data, and you got to sift through the noise to figure out, well, what do you do with this information? So the big news today, another 3.2 million people for the first time filed for unemployment in the last week. Now, this is higher than what was expected, and once again, as I'm recording this right about the time the stock market opens, as that news was delivered to Wall Street at 8:30 a.m. this morning, the futures went up. So again, I shared this with you last week. That's peculiar. We've got record levels of unemployment, and honestly, 3.2 million new people file for unemployment. That would have been a record a couple months ago, but that seems low compared to the 6.8, the 6.6, the 5 million, and so on that we've seen. So that now puts the total of new applications for unemployment just in the past month and a half over 30 million, closing in on 40 million. That is just staggering. That is just staggering. Now, the other big headline, states are starting to loosen up. States are starting to allow businesses to go back to work, which means people hopefully will be coming off of unemployment and going back into their jobs. What will that mean for the unemployment rate? Of these 35 million or so people that have applied for unemployment, how many are actually staying on unemployment now that businesses start to open up? The interesting thing for the economy is many of these workers, because of the unprecedented benefits in the CARES Act for unemployment, they might even see their pay go down when they go back to work. What does that mean? Will they not want to go back to work because their pay is going down? But two, will they not want to go back to work because they feel it's unsafe? That's the third big headline, is we're starting to see, even though that case numbers for the coronavirus have plateaued, certain states in the Midwest are starting to see peaks and new highs. And right as there's all this social pressure for companies to reopen and states to reopen. Now, I'm not going to share my own personal view as to whether the closures are overdone and whether people should all wear PPE or whatever, but we've got this huge conflict within our country, and that's creating a big conflict for the economy, and yet the stock market continues to go north. Now, add that in with another headline that came out earlier this week, record level of household debt, never before seen, over $14 trillion of household debt. And I want you to see the charts on this. And so I'm going to link it below. The charts are just astounding, and they actually point to something else, which is not the topic of today's video, but the staggering way that student loan debt has just persisted over the past 2 decades. It's gone up and up and up and up, even though we saw household debt peak in 2008, a lot of it due to mortgages and so on, and then drop down as we recovered after '08. And guys, it's way back up, and it's higher than it was in '08. And it's interesting to look at that student loan debt. But we're at record levels of household debt. So what does that mean? The consumer is very vulnerable and they're very leveraged at a time when a record number of people have applied for unemployment and businesses aren't operating at full capacity, nowhere near that. Wow, this is a dangerous, dangerous recipe, and yet the stock market's going up, which leads me to my last headline before I get into application, and that is right after, where I get my financial news from, right before I started recording, right after the article that said 3.2 million new people have applied for unemployment, it was what to expect from the 4th stimulus package. And I actually am ready to do a video about the 5th stimulus package, something that's being proposed in the Ways and Means Committee. called the Savers Act. I will hit that probably next week. But the fourth stimulus package, that's in my opinion, Wall Street's either going up because they expect a vaccine will solve all this, they expect everyone's going to go back to work and the economy is just going to go right back to where it was, or it's just expecting another stimulus. I think the third is the most likely. And what should we expect in the fourth stimulus? Well, should we even expect it to begin with? And I think so, because we're junkies and the economy is in so much trouble. That I do think there will be more Fed spending and more Congress spending and another stimulus. What should we expect? Likely aid to state and local governments, which is going to lead to one of my applications for today. The cost of the coronavirus and dealing with this is putting huge pressure on states, and huge pressure. Number one, their costs are going up to try to care for this and react to this and respond to this, and their revenues are going down because you're going to see income tax revenue go down, you're seeing some sales tax revenue go down, and you're seeing property tax values likely to be reduced after this, so that revenue is going to go down. So this is putting a lot of pressure on state and local governments, so likely they're going to need some aid. Testing is another one. I don't know who you believe, but testing still sounds like it's a problem, so there appear to be more funding for that. Small businesses. The PPP loan has not, the wave 2.0, I should say, of PPP has not run out yet. That's surprising to me. I was thinking it'd be running out by Wednesday, but maybe pushing all of these big businesses away from getting this small business aid has allowed it to help more small businesses, but they're likely going to need some more help. I'm hearing from businesses that saying it's not worth it to reopen yet, and we might not be able to reopen. And then likely another stimulus to end individuals. Whether that stimulus comes in expanding unemployment, extending unemployment, or another check, another tax credit. We'll see. That's all going to be on the docket. What in the world do you do with this information? Well, because of the damage that state and local governments are in, if part of your investing strategy is municipal bonds, I would be careful. Make sure that you're owning conservative, high-yield municipal bonds are high-risk municipal bonds at a time when municipalities are facing high risk. So I'd stay clear. I'd be watchful for using a mutual fund that's in muni bonds that's high yield. And I would just make sure you're diversified. Municipal bonds offer a great benefit, but again, be on the lower risk and be diversified if you're using those. And this might be the time to have a more active strategy with municipal bonds. And then the second big application that I would tell you is it's very possible this market continues to get pushed up. And it's very possible that I don't understand the reason, and that doesn't matter because the market is going to go up and then we get a vaccine and we're past this thing. But if the news isn't perfect, the stock market's likely to remain extremely volatile. Now is a time, as the market is now only down 11% year to date, now is a time to look and say, do I have the right amount sitting in cash? Do I have the right amount sitting in cash for the withdrawals that I'll need over the next 2 or 3 years? I've got a meeting later today with someone who was laid off, spouse is already retired, and we're thinking, well, is that it? Is she going to stay retired as well? Therefore, how much money should be in cash that they'll need to draw out over the next few years? So do that work in your own financial situation. And then finally, I look at having an adaptive, a momentum strategy. If things have swung way back up, but we're nowhere out of the woods, that's usually how it works, by the way. The markets recover long before the economy recovers. It's just there are still these huge, enormous variables in the economy. It just makes me more nervous this time that we have officially recovered. And I would make sure that you've got a momentum strategy in your investments. Our momentum strategy, we call Dynamic, was completely in cash by the end of February. It rode all of March in cash. In April, it started dipping back in. We're about 50% in. And our models are only showing that it's only safe to be in one particular sector, one particular area of the investing world. So we're still keeping a lot in cash and only focusing on what's doing well. But I talked to our manager yesterday. He's very cautious and will be very quick to go back to safety if it looks like we need to. So be careful with your municipal bonds. Consider having an active strategy. Make sure you've got the right amount in cash, and I would make sure you have a momentum-based strategy as part of your overall portfolio. So those are our next wise steps today. Again, if you have any questions, you have any needs, if you need comprehensive financial planning, because all of this recommendation, how do you apply it to your life? Comprehensive financial planning. Okay? If you're looking for a certified financial planner, you can always call our team. You can call us at 574-247-5898. You can call or text us right there. Send us an email, info@korhorn.com. That's Korhorn with a K. And we're online at thewisemoneyshow.com or korhorn.com, KORHORN.com. All right, you're ready. Go out and take your next wise step in your financial life.